reading and all over the place. Like, look, you know what? Let's just do this. It doesn't matter, man. It doesn't matter. Who cut your hair? I cut it. I cut it with a knife. It's fine. Don't worry about it. Don't worry about it. It's fine. Who cares? Who cares? We're taking it all way too seriously. All right. Does Garrett ever show management of the runner? What does that mean, David? We literally do this at 9 o'clock. It'll be here at 9 o'clock. All right, I'm going to finish this coffee. I'm going to drink this water. And I'm going to say hello to you. All right. So, as we always do, reminder, why are you here? Well, 9:30, market's going to open. Markets are down to start the day. A little bit of futures noise chopping around at the moment. Under that 6,700 level, watching crude continuing to slide, watching gold hit new all-time highs, sitting up there at that 3,750 level. Ooh, love to see silver at 43, considering that I've been long since 25 and long gold since 2,100 as well. Russell 2000 at 2459, and the Nikkei pushing to new highs as well. All right, remember, you are the exit liquidity if you are not preparing for the market morning, okay? Morning market. If you get a good haircut, you won't need to comb it for a month. Okay, guys, I get it. I get it, okay? I get it. Every single part of my head is a cowlick. I am Dennis the Menace. I get it. You don't have to remind me. All right, tell us about the runner, so the entry, but you do ever exit the runner, so management. No. Again, this is about ideas. If you want us to start tracking it, more than happy to start doing that. All right. The stocks are actually worth engaging and trading today, whether the market is ever safe. Remember, when I talk about specific trades on the runner, I set limits. I walk you through those limits. I tell you exactly where the exit points are. These trades are typically around moving averages. So, yes, we will make sure that you have entry and exit strategy lined up as well. We're going to talk about where the smart money is positioning as well. Top screens, top trades, top strategies for the day as we get going. All right, momentum is green. And once again, as you remember, as we head into the week, it is very important to always understand weekly momentum. I know you're having a good time, Old Dog. I know. I'm not taking it personally. I'm just kidding. All right. So remember, number of stocks in breakout territory compared to the number of stocks in breakdown territory. We take every single stock on the S&P 500 and we put it on a bell curve. We break that bell curve up into 7 different positions that stocks can move. We take the number of stocks in segment 6 to deduct the number of stocks in segment 2. And if it is negative, we check the FNGD to see if the pressure on the equity market is coming from the top of the S&P 500 stocks. Now, here's the important thing to keep in mind. Very important to keep in mind. Understand that last week, the Magnificent Seven was up roughly 2.5%. The rest, 495 stocks, they were down or flat. Not a lot going on. So again, all of the leverage in the system, all of the capital pushing into the markets remain the same equities, the same names, all of these massive ETFs. We have more ETFs now than we do have stocks in the U.S. markets. That tells you everything we need to know about price discovery. And it also tells you that that biweekly wave of capital that comes in retirement, 401k, Roth IRA, all of that money pushing these equities and providing support for these equities through those ETFs and those retirement funds. Okay? So we are not seeing leverage exiting the system right now. We look at the MAGS, which is very, very, very strong, remaining not just above the 20-day moving average, but continuing above that 8-day EMA with very strong momentum. We've only had a few ticks on that 50-day moving average since May. Liquidity remains strong, markets remain strong, and we will let you know if this market is breaking down and if pressure is coming. But for right now, we have gotten through one of the most tumultuous weeks of the year, which is the third Friday week of September with triple witching. You'll notice Triple witching has been beaten into me. Don't worry. I'll say it wrong again. I'll get there. 65.14 on the Magnificent Seven. Very strong on these equities. We continue to see strength. We continue to see liquidity flowing in. Strong momentum. It's not about the rate cuts. It's about the liquidity. And I'm going to explain that in a moment. Now, the big three stories right now, Trump's $100,000 H-1B visa proposal. U.S. is going to charge a $100,000 fee for new H-1B visa petitions. This has an impact on tech. This has an impact on Indian IT services as well. Just want you to keep a very close eye on these stocks. Now, I'm not telling you to necessarily trade them per se or invest in them, but these stocks, because of the headline risk associated with them, can become stocks to trade on volume-weighted average price. If Infosys or Wipro or Cognizant sell off, if they sell off and we see any challenge to them, remember, short term, these stocks can become reversion trades if they get overextended. Pretty simple, very simple trade. You're looking for pressure on these names on the third deviation band. So remember, volume weighted average price. We add the deviation lines. We'll put the link in the chat for this. Third standard deviation, if any of these names sell off, if there's enough liquidity and there's enough capital flowing, we are looking for reversals on names like this. And it's not just Cognizant, it's not just Infosys, it's not just Cognizant. It is Amazon. It's Amazon, it's Apple, it's everything. You can trade any name like this looking for these moves off the third and fourth standard deviation of price. Very simplistic. All right. On top of that, we have gold hitting new highs. I hate to say I told you so. Gold futures pushing record highs after the Fed rate cut and policy uncertainty. That's what the headline tells you. But we have added $15 trillion with a T. $15 trillion in liquidity to the global pipeline since January 2024. Gold is a reflection of money printing. The GLD, gold futures, any stock tied to it, GDX. GDX has just been a monster this year. And why is that? Because gold miner margins are through the roof right now. Gold miners, silver miners. How do you trade this? What do you do? Well, you don't chase the momentum right now. But what you're definitely doing is you're going to trade around that 8-day moving average if it pulls back. And the GDXU is that leveraged ETF. This thing has gone from 65 to 183. The GDX underlying has gone, since that May momentum move that we've talked about, 47 to 73, 75. And people keep saying, well, can gold go higher? Well, do you think they're going to keep printing money? Do you think they're going to keep expanding liquidity? Then yeah, it's going to go much higher. Our target right now is 4,000 for the end of the year. We're looking at 4,500 for next year, and then we're going to push 5,000. Why? Because the liquidity cycle continues to expand. And then we'll see contraction probably late 2026, 2027. But for right now, all roads point to more monetary expansion. And this can keep going. The more they keep printing money, the higher it will go. Fed rate optimism, extended valuations. This is a lot of fun. I really like these articles that I'm reading from Wall Street where they're taking random analysts. There was a great article that I wrote about this morning where somebody said, well, this is not your grandfather's stock market. Yeah, because the grandfather had price discovery and the gold standard. We have money printing. We have the theater of rate cuts. The Federal Reserve is not independent. Last year in August after Japan collapsed. The Fed had to continue to be accommodative. So did the U.S. Treasury Department. This happened in '08, and it happened in '98, and it happened in '15, and it happened in '11, and it happened in '16, and it happened in '18, and it happened during COVID, and it happened in 2022. The BIS, which is the central bank of central banks, has effectively said, look, none of these central banks are independent anymore. So all of this is theater. Who cares? They are cutting rates. Fine. We had interest rates at 5%, and they were still expanding the monetary base. They just told you that they weren't. Oh, well. Since 2017, the continued expansion of liquidity has driven the S&P 500 to record highs. We continue to borrow. We continue to print. And everything that is on this chart right here, NVIDIA and Apple and Tesla and the Qs and the SPY and everything related is tied heavily to the leverage that is built on the back of this system. And if you need proof of an understanding of what's going on, look at this chart. It doesn't matter what they're doing with rates. This line keeps going up. Like the price is right. That the yodeler, the guy, he just keeps going up. That is global liquidity. That is what drives equity markets, that chart. And if you need proof that when there are contractions in this, that the markets don't do well, remember the gilt crisis, and remember what happened in late 2023 when our interest rates, 10-year bond went to 5%. They will continue to expand liquidity. That will continue to expand capital. There are people sitting here. This quote absolutely blew my mind this morning because it just showcases that people are locked in the past when it comes to the equity markets. They're still viewing everything through the 1990s. This quote comes from Jeff Kruppelman at Mariner Wealth Advisors, explaining 23 times forward earnings is reasonable because, quote, return on equity and profit margins were far lower in those times. What? That's the reason why the markets are at all-time highs compared to when your grandfather was an investor? No. We've added $15 trillion in global liquidity since 2024. The article mentioned everything: AI productivity, Fed rate cuts, earnings prospects, and historical bubble comparisons, and does not mention the money printing. Money moves markets. That's Michael Howe. Liquidity moves markets. That's Stanley Druckenmiller. Guys, this is not that complicated. Don't make it complicated. If they are expanding, if they are accommodative, even if they are supportive, markets move higher, particularly the stocks at the top of the S&P 500. The top 10 stocks on the S&P 500 are 39% of the entire index. Why? Because of ETFs, because of retirement funds, and because of the leverage that is pumped into this system. And I have explained time and time again that the S&P 500 is a reflection of liquidity in the system. This is from the Wave speech. I'm going to find the chart real quick. I just want to point it out because it's so mind-numbingly obvious. This is the S&P 500 since COVID. This is the Chicago Fed National Activity Index, right? It's supposed to track things like productivity and spending and jobs. You have risk, leverage, and credit. Flip it upside down. It's the entire chart. It's the same thing. Since 2020, stocks stopped caring about profits and growth. Now we're focused on money printing, the kind of debt the Treasury issues, how much collateral Wall Street has to gamble, momentum traders chasing whatever is fast and popular, and liquidity events. And we go back to 2020, Archegos in 21, the gilt crisis in 22, Silicon Valley banking crisis 23, Japan crash 2024, and the trade crash recently in April. What happened every single time? They accommodated, the insiders bought, and the markets took off again. We're waiting for that day. And trust me, it's going to come again because we're having at least 4 Sigma event every year since COVID. And we already had one big one this year. We're going to have another one in 26. We'll probably have 2 or 3 in 27 and 28. And you just have to be very patient, and you have to wait for the accommodation, and you have to let the market do what it does, which is recover and, of course, move back to all-time highs. We're looking for a Gianni level generational buy, everybody. All right. It is 9 o'clock, which means it is time to do something very exciting. What is that? What are we doing? What do we got? We got the runner. So let's take a quick look. BAM, Brookfield. A lot of excitement around Brookfield right now, everybody, because of their AI trade. Big pullback. This is a buy and own forever stock, but the continuation of momentum, you see the 8-day moving average pushing above that 20-day moving average. As I have said, buy at the 20, sell at the 8. Look at that. See that move, 48? And instead of having the 20-day as your exit strategy, you're buying when that crossover happens, and you're letting the stock move up. And if it continues to move up, you exit at the 8. That's it. 55 to 61. Right now, you're seeing this crossover here. Your stop for BAM is the 58.76, but I'm going to make it a little bit easier for you because this is something I want to own. I want to own it at a lower level. So rather than just trying to chase the momentum, what I can do instead is just simply look for an opportunity to sell a call, or forgive me, sell a put and buy a put as well. Pretty simplistic. So let me get off of that real quick. One moment. Let's fire this up. All right. Oh, good. They're going to send me text messages. Good. I can't get into Thinkorswim again. Great. Sorry, Don. I apologize. Credit spread. We got to go to this stupid website real quick. $800 ads. Don's having a heart attack right now. I apologize. I'm sorry. You're writing. You're buying. You're doing all the things. Go out to November. Selling the 55. Buying the 52. November 21st, $55 put for BAM, currently sitting at 60. I am content to buy this stock at 55, right back at that 200-day moving average. That's why I'm selling the spread at that level. Now, I want to point something out. The reason that BAM sold off the way it did in April had nothing to do with Brookfield. It had everything to do with a short-term liquidity crisis. The selling that happened last August had nothing to do with Brookfield. It had everything to do with a leverage and liquidity issue. Over the long term, I am content to buy Brookfield Asset Management. Therefore, I will trade it to the downside, selling a spread, putting up $200 to make $45. This is right in my wheelhouse. This is one of my favorite trades. Something I want to buy, that I am willing to buy, and rather than having to put up $5,000 in margin for the purposes of trying to generate a 2% gain by selling just a $55 cash secure put, I can go up to 10 of these contracts, put up $2,000. $45 is what the return would be on that 200. Your break even is 54.55. Probability of profit right around 80%. Max return right at 20%. Annualized return over 100%. Why do I do this trade? It's called the 80-20-100 trade. Okay? Because I can do it over and over and over again. And what my goal is with Brookfield is to sell to the downside. And so long as we avoid these bigger liquidity events, again, we're following momentum and we're following the FNGD. If we don't have these big negative events, and again, we are out in front of them, if the market's going to sell off and we see a big momentum event like we saw happen back in February, we just buy the contract back and we get out of the way. And then we wait for the opportunity for this stock to potentially get down into oversold, and then we sell the spreads again. But for right now, back at that $55 level, so long as liquidity remains ample and so long as momentum remains strong, I can go out to 60 days, $200 to make 45, 22%, and I'm looking to do this trade 5 times this year. Okay? Selling $55 put for November, buying the 52.50 put, $200 to make 45, 22% max return on risk, probability of profit 78. Instead of trying to follow the momentum and having a low probability of profit in the 20 to 25, 30 to 45% range, this trade gives a 78% probability of profit. And I want to remind you, okay, not a lot of people like selling credit spreads. I get it. I'm showing you why this is important, because if you have 3 trades, all calls, all individual calls, 3 calls at 33%, 33% probability of profit. What are the odds that those 3 trades all finish in the money and all make you money? 33% times 33% times 33%, 0.33 times 0.33 times 0.33, oh, less than 5%. What are the odds that 3 credit spreads with an 80% probability of profit all make money? All 3 of them. The answer is 52%. Okay? It's about knowing the numbers. It's about knowing the profitability potential. And it's about following the averages. And if the stock breaks under it's 50, it's 200, and it's 8, then yes, buy it back, take the small loss, and move on. But for right now, again, something I want to own for the long term, rather than trying to chase the momentum, I'm simply focusing on the probability of profit and looking to make a 20% gain. Adobe is back. I missed this stock. This thing got killed. And again, this is supposed to be a major reflection of subscriptions, jobs. Well, look at what happens. We are now back above that 20, that 50, and that 8. We're seeing some strength. And for right now, I'm going to wait and see where this stock goes today. I can get a feeling that it's probably going to retest that 50-day moving average. But if we retest that 50, that's where I'm buying at the 360 level. And then I am selling up at the 370 level. We're looking for a little bit of a reversion on this name after continued weakness that we have seen in the subscription space. Again, the software application space has been beaten up a little bit. Now with interest rates potentially on the verge of moving down 1 cut a month for the next couple of months, well, this is where we can see the recovery and actually get another move back toward that $400 level. ENVX, I don't know what you do. And Novix. Keep an eye on this one. You want to get above that 50-day moving average before taking action. That's a 1018. At 1018, you have a buy here on this electrical parts company. But for right now, close eye here. Watch that 8 and that 20. If we pull back and we hit 965, simply buying the stock and looking for a continuation of momentum. You can see that this has done very well on those 820 crosses. We've seen some solid moves. We saw this move back here from 833 up to $16. Just again, looking for momentum as it goes. Lucid, oof, you're back. Good to see you. I'm buying above 2137. Line in the sand, looking for a move back to that 200-day moving average. Keep this one very close to chest. Write this down, 2137. As a buy, your stop will be back at the 20-day moving average, right around $20.20. On the downside, MKC, McKesson. No, wait, McCormick. Oh, no, I can't go against you. That's not good. What happened here? Man, look at this chart. Oh. So, for those of you who do not know, I grew up in the board room of this company. I bartended for all of the McCormick family. I learned how to pour scotch at 5. I didn't drink it until I guess I was 8. But that said, if you pay very close attention to McCormick, it is all about this. This stock was trading at 35 times earnings last year, and it continues to bleed off. And unfortunately, this company has made series after series of mistakes in its acquisition model. I said it. This company went a little too corporate, and they are attaching to the buy model rather than the build model. And we are under multiple tests of that $70 level, continued weakness here. I don't want to try to short this at this moment, but I will state this. If this stock gets into oversold territory on both the MFI and the RSI, I would look to be selling spreads down at the $50 level. Yeah, that's where this can go. Cash flow looking weak, price to cash pretty weak. Man, book value at 2087. That is tough. That is that breaks my heart a little bit. Man, I was a great bartender at 5. I will say that. J&J. Ha. All right, 176. We're looking for a move back down to that 172 level. So you're buying, maybe buying the 175 and selling the 172.50 if that's in line. If not, you're looking at the 175 to the 170 level. You are setting your stop. So somebody said, how do you manage this, Garrett? My reminder is this. Your exit for a trade on this is when you're buying a put and you're selling a put and you're doing a spread. That spread, that put that you're selling will provide a little bit of a buffer in terms of enabling you to protect potential downside. So let's just look at an example of this. And I want you to really understand the difference between a long put and a put spread and what the numbers say. So if we look at Johnson & Johnson, and we don't have these metrics on any other website to tell us what our probabilities are, do we? If we went out to October 17th, and hypothetically we bought the 175 put, your max return is 17,000. What is happening? Okay. Your max return is that the company goes bankrupt and disappears into the ether. This is, you will, if this were to happen, I'm just going to warn you, you would never get that money because the earth has been swallowed by the sun. Johnson & Johnson, 17,220. Yeah, that's not going to happen. But let's just, again, if you buy a put at the 175 level, this matrix will tell you what your expected returns are so long as implied volatility does not change. If you want to change the implied volatility, you got a scale right here. You can do that. But once again, let's just say that the stock goes to 178. It breaks above these key moving averages and just moves higher, and you're a little late getting out of the position. Well, you would be down 31% right away, right? Let's just say that you set a stop back at the 20-day moving average, which is 176.33. Okay, we're still operating off of yesterday's numbers, but you could see a 7.5% move. That's what your losses would be. All right, if you do a put spread, all right, oh, one last thing, forgive me. Your probability of profit is 34%. That's an important thing to keep in mind right now. 34.5%. All right. If you bought for the 17th, the 175, and you sold the 170, okay, you will see that your probability of profit has increased to 40%, and your break even has changed, and you have a defined max return on risk at 254%. Remember, a lot lower than 17,000, but as you could see, if the stock moves back to those moving averages that we were talking about, 2%, 3% loss, the stock can go to 176, right? Go to 176, and you're barely going to lose anything. So it's just a thing to remember. If you're doing those spreads, selling that additional put and defining it around a very specific moving average, and in this case, we're looking below the 50-day moving average. But you could see right here, that 7 to 10% versus a 33% loss when you get up into that 178 level. It just becomes a cushion for you to define your risk right up front. All right, last couple of things. ROST. I don't know what you do either. Ross stores. Oh yeah, this is a thing. I missed this one. I'm sorry. It's too late. Um, you're kind of in no man's land. So you've got to either get under this 50 day to that 144 level, and then you would effectively go 145 down to 142.50 or 145. But I don't like trying to trade between these ranges. I like to make the trade exactly after it buffers under that 20-day moving average. Other horses to watch. All right. Well, on sector momentum, just be very aware that momentum remains very strong. And it is reflective in the fact that technology, communication services, and cyclicals are all strong. Monthly upward movements on communication and technology and consumer cyclicals. These are the momentum sectors. When momentum breaks out, it's these three names that you want to pile into. This is where the beta is in the industry. High beta technology, AI, a lot of small cap stocks as well, with reversals in the common technology. Just be very, very cautious, though. Understand that when we start to see the FNGD break out above its 20-day moving average, these stocks will unwind very quickly as well. Things that are breaking down, well, no shocker here. Consumer defensive continues to weaken, and that is because of the strength in the momentum. And we're seeing some rotation in the utilities. Again, utilities have been extraordinary this year, going back to right there, 9%, 10% on the year. That's not supposed to happen, right? This is the AI trade. This is all about infrastructure. All right, what else is in play today? General Motors. I mean, I don't really know how to explain it other than, again, high F score, strong gram number, push above the 20-day moving average. The stock has gone from 52.27 up to 59. And I've said time and time again, just look for these moves on the 8 and the 20. Stay above the 8-day moving average and use the 8 EMA as your exit. In this case, the trade would have been 57.29 to 58.16. And I know you will take 13% any day of the week that you can get it. My last stock is EBS today. Emergent Biosolutions. I don't know what this does. I assume it probably makes something out of horses. But strong momentum, this improvement, you're seeing that crossover right now on that 8. So I'm buying the stock and I'm setting a stop right back here at $8. Buying EBS at 8, and I'm looking to exit somewhere around that 9 to 950 level. We will make this part of our conversation this week. EBS, buying at the open, setting a stop right back there at that $8 level. All right. We did it. What an incredible time. Genesis Cog is short ROST. Well, that's all you need to know, right? At Bierman. Bierman is just so good at shorting. It's such a hard thing to do, man. It's a hard thing to do. And I have not figured it out. The only time that I short and I go aggressive on it is when we have these liquidity events. But it takes, even in the situation where we see these overbought conditions, look at this ROST. You get overbought, and what's the stock do? It goes up. So, as you can see, Jeffrey Bierman, CMT, killing it on Ross right now, being short from that 150 level. All right, just going through the chat real quick, making sure I didn't miss anything. Where's the runner? Ed, look up. It's above you. It's above you. It's there the whole time. All right. I wonder if they can calculate the amount of ads that they can pop up before you have a seizure. The answer is all of them. Homer Simpson website. This is option profit calculator. Anybody remember that? Anybody watch The Simpsons back when it was good? Homer created a web page, and that was his web page. All ENVX's batteries. Right about the HB1 visas, it might change your mind. Cool. We will check that out momentarily. The McCormicks live right here in Manchester, Vermont. I drive by their house all the time. I was just with them. Can we get some coupons from McCormick? We have a bunch of bottles upstairs of my father's face on them from his retirement party in 1995. And it says Hot Shot. I will say one thing, though. When it comes to McCormick, Montreal steak seasoning, it's the best of the best. All right, can you please go over the daily trade you covered in Friday's afternoon thing on the SPY? That is the reversion trade. So I got to wrap it up in a moment. But once again, what you're doing is you are setting up your deviation bands and you are looking for moves down here at the bottom of the third standard deviation into the fourth deviation line. And as you can see, we tapped that line the other day and we got a nice check mark into the end of the day. What happens is if you're at that level, buy whatever is in the money on the SPY. And in this case, it was the 660 level. I believe this went from about $1.08 up to somewhere around 250 to 260 by the end of the day. So once again, actually, it would have been a lot higher than that. It would have gone to $4 minimum, right? Because of the intrinsic value. Anyway, I'm not sharing. I'm so sorry. Real quick. And then I got to go because Don will yell at me. Here we go. 11:30. See that tap? Third standard deviation. Moved into the fourth, outside the Bollinger Bands. We don't have that listed. You buy whatever is at the money. And if you buy what is at the money, you set a tight stop in case it rolls over and you're looking for a move. So again, 0-date options around the SPY. We'll talk more about this today at 3 o'clock, but in a higher volatility environment, this trade really, really works. It also worked out great on Friday. All right, I got to go. Don's going to throw in some music momentarily. If you are not a member, you can name your own price. Click the link in the chat, and we are going to go from there. I hope everybody has a great trading day. Don's coming up to throw on some music. Do me a favor, everybody. Don't make fun of my hair too much. It's not good. All right, I might just shave it off. I'll talk to you guys today. Have a great day.